CEOs and co-founder of Real Vision, Raoul Pal says he's looking out for signs of an impending recession in the yield curve. Raoul says the rate cycle is going out of character, which could mean either of two things. The market might be tightening to correct some defects, or we could be heading for murkier waters. Raoul also draws a similarity between the abnormal movement in the curve to a similar movement in Japan's yield curve in 2010. Following that incident, the country's bond yields are yet to recover after all this time, and there are signs we might be heading right in the same direction. Welcome to Savvy Finance. In this video, we examine Raoul Pal's macro outlook on the rate cycle in the yield curve and how it could be pointing at an impending recession. Please watch the video to the end, click the like button, and subscribe to the channel. Raoul Pal is an investment strategist, economist, and the CEO and founder of Global Macro Investor. In a series of tweets, Raoul shares his macro outlook on the current movements in the yield curve. Using a graph, Raoul explains that the yield curve is flattening much earlier than expected and at a lower basis point. If this continues, it could hint at almost irreversible damage to the bond yields, similar to what happened to Japan's in 2010. There is something interesting about this rate cycle in the yield curve. Normally, it does not really flatten until a couple of years post-recession and normally at 250 basis points. Now this could be a correction, but if it breaks this line, it suggests a shorter cycle than normal. Raoul's first tweet reads, accompanied by this chart of the yield curve. Raoul further explains that this might not be directly hinting at an impending recession, but it does show that the bond market is having problems tightening without slowing down growth. In another tweet, Raoul points out that a similar movement could be noticed in Japan's yield curve in 2010, a downturn from which the country's bond yields are yet to recover more than a decade later. Raoul writes, "This does not mean a recession is imminent, but it means that the bond market sees less ability to tighten without slowing growth. We saw similar in Japan's yield curve in 2010, lower than the usual 150 basis points. And Japan's bond yields never recovered." The investment strategist accompanies the last tweet with a chart showing the state of Japan's bond yields since the downturn in 2010. But Raoul says the best course of action for now is to observe the progress of the rate cycle. As stated earlier, it might be a correction. But if the yield curve flattens and breaks the line, it would be a whole different story for the equity market structure. No action points right now, but just observing. If the yield curve in the US flattens, breaking the line, it suggests that rates cannot rise much, and that will shift equity market structure back to long-duration growth as GDP growth is less likely to be supportive of cyclicals. Watching, he adds. In another series of tweets, Raoul Pal also points out the absurd difference in the year-over-year change in two-year rates. He explains that though rates are up by a lot, the cost of servicing a leveraged position is also high by a lot, a buildup that could have a great economic impact over time. You will label this as chart crime, but the year-over-year change in two-year rates is absurd. If you did fix in two-year rates in the crisis and took on leverage, the cost of servicing it is up a lot. If leverage is high, the absolute level of rates is not what matters 100%. This might not be the biggest factor, but it is important in terms of economic impacts over time. Raoul Pal writes, "Soon it will be time to buy bonds, where diamonds," he adds, referencing an old market saying from the late 1800s and the early 1900s. It goes without saying that some immediate steps are required to set the market right. Inflation is currently at a 40-year high and continues climbing. Traditionally, the Fed uses the interest rate to even out things and get the economy back on track. But that does not seem to be in the best condition either. Hopefully, things will take a positive turn in the coming weeks. Thanks for watching the video. Remember to give it a thumbs up, subscribe to the channel, and turn on post notifications so you never miss any of our regular uploads.